Scott Greiper, everyone. Very good friend for many years. Viridian has been a leader in cannabis investing since the very early days. Scott, tell us a little bit about Viridian and what you've been doing.
You know, nothing. The industry is kind of boring and staid. There's nothing changing, nothing challenging, so just kind of hanging out. First of all, good to be with you. He and I met 5 or 6 years ago, and you've become the leading journalist in the industry globally, so congrats on you.
Thank you. But let's focus on Viridian. That's what we're here.
Okay, that's enough on you. We started in June of 2014. We were the first investment banking platform in the U.S. cannabis industry. I think there were 6 legal states at the time. I think the year we got in, there was about $400 million raised in the industry. So far through the first 9 months of this year, it's been over $5 billion. So the capital markets have evolved as we have, and still finding this industry fascinating and challenging and full of opportunity.
That is definitely true. I think we have a slide. Can we bring it up? Talking a little bit about the markets and how they have changed. We've seen some corrections, right, in the market. One in 2019, one this year. And one of your theses is that corrections weaken public companies as acquirers, right? Can you elaborate on this and how you've seen some of the markets, public markets especially, change 2019 versus today?
So hopefully all of you guys out there are on our mailing list to receive the Viridian Cannabis Deal Tracker, which we've been publishing since January of 15.
It's gold.
Thank you.
It's gold. Tracking
every capital markets deal in the industry: debt, equity raise, M&A, public, private, buyer, seller. We've tracked about $70 billion in deals. So we know who buys what and how they value companies and whether they pay stock or cash. We know how investors invest. We know how lenders lend. We don't charge for this information. So if you go on our website, it's free, but we use it when we're out representing a client in the market because we know what we're worth. We know the structure of the deal because we know the last 30 deals that were comparable. But to your point, what's really kind of fascinating about today's environment versus 19, if you guys remember, 2018 was the first rocket ship in the public markets. Mm-hmm. The public cannabis markets went hog wild after the midterm elections of 2018. And a lot of states legalized medicinally, medical to rec. The markets went nuts. And it all broke in the second quarter of 19. You guys remember the Canadian LPs started reporting very disappointing results. That was kind of the first crack in the armor of Canada being this massive market, even though it's the size of California. So the market corrected. You could see the 4 quarters of 19, the decline in the capital that came into the industry because the public markets cracked. Valuations came down, capital became scarce. And as a result of capital becoming scarce for the public companies, they became less powerful buyers. Recall that in almost 9 out of 10 acquisitions in the industry, going back to 2015, were public company buyers of private cannabis companies.
Yeah.
So when they have a ripping stock price to use as consideration for a deal, and they can raise as much non-dilutive capital at that high stock price, they're buying everything. But when the capital dried up, so did M&A. I mean, it virtually dried up to nothing by the first quarter of 20. So the decline in public market valuations led to a decline in capital availability and weakened the public companies as buyers, which led to a decline in M&A. Let's take it to this year. Can we go to the next slide? Well, here's 2021. As Tim and his guests were just saying, we're in a capital-starved environment. Mm-hmm. Public market valuations are down 50%. Hasn't impacted the M&A market like it did in 2019. We haven't showed a decline in transactional frequency in the first 3 quarters. Why? It goes back to what Tim was talking about before. The fundamentals of this industry, particularly the large MSOs, the large publics, are the best they've ever been. Visible revenue growth, visible profitable revenue growth, lots of assets, underlying real estate. The fundamental strength of the industry, particularly the large public companies, has never been better, and they're not getting credited for it. The stocks are down 60%. So what do public companies have to do? They have to feed the beast also. The beast meaning somebody's got to trade the stock. We need some headline news. We need something that's disruptive to show the investor, yeah, we can grow organically, and we are, but we're also going to be very targeted strategic buyers. So the onus on the public company to generate accelerated growth through acquired growth is more significant and extreme than it's ever been.
Mm-hmm.
So usually you see a decline in valuations, decline in capital, decline in M&A. We've not seen that this year.
Now we've seen, we talked about how acquirers have changed, or the nature, of the acquisitions, but there's also a change in targets, right? We went from seeing all these publicly traded companies acquire operators to a much more diverse,
No doubt.
set of targets. What has been happening, and what are you seeing in terms of the market today? Who are the most interesting acquisition targets?
I think two kind of changes to what you normally see in this industry, others. One is public companies usually don't acquire other public companies, right? The public companies are there for the private company to go, oh, you're going to buy me, and I'm going to get some cash, great, and I'm going to get your stock. And if I believe in your stock, meaning there's fundamental strength, there's good liquidity, that's kind of my exit. And I get 2 bites of the apple. I get cash off the table,
Mm-hmm.
I'm a private company, and then I get public stock. So I'm effectively going public. Beautiful. That's not what we've seen this year. 6 of the 10 largest M&A transactions this year were public companies buying public companies.
Mm-hmm.
That's unusual. Why is that? It's all an arbitrage play. The gap between the valuations of the 10 or 15 largest public cannabis companies and the next 20 public cannabis companies is 2 to 3x in value. Even though those next tier companies are growing faster than the larger companies, they're trading at lower valuations. Well, that's backwards.
Uh-huh.
But nonetheless, there's an arbitrage being in the market right now for the public companies to look at the 50 million market cap, 150 million market cap, 100 million market cap, and the 3 billion market cap companies are going, well, that looks cheap.
Mm-hmm.
So that's one of the shifts in the M&A market. You have pubcos buying pubcos. That's not typical of an industry that's aggregating and consolidating. It's public buying private. So that's a shift. And then to your point on diversity, so almost 9 out of 10 M&A transactions since January 15 that we've been tracking have been the MSO buying the private single state licensed operator. You saw PharmaCann buy LiveWell in Colorado 2 days ago. That's the metric we've seen almost for 6 years. It's been cultivation and retail public buying cultivation and retail private. That's what the MSO does. But in the last year or so, we've seen software get rolled up.
Mm-hmm.
One of the first SPACs that listed on NASDAQ became Akerna. They acquired MJ Freeway. We just sold Akerna, a cannabis ERP company. So
365.
software is being rolled up, 365. The brand industry finally is starting to get the attention of the acquirers. So you saw the largest Canadian SPAC, Subversive, by Caliva.
I mean, Wana Brands yesterday.
Harborside buying Sublime. So there's been a brand roll-up. We're starting to see roll-up opportunities in certain segments of the industry. So not only cultivation and retail, because that's the MSO model, but brand, software, and biotech. You saw Jazz buy GW Pharma for $7 billion. So there's more of a diversity in the eyes of the targets, and that's really good for private companies that are not a state licensed operator.
And then there's another change, right, in terms of the targets, right? And there's a focus on value. Finally, there's a focus on fundamentals. Finally, there's a focus on acquiring companies that will add to your bottom line, that will impact your financials in a positive way, and not just acquiring for the sake of, acquiring an asset, right? Tell us a little bit about that trend.
So if you guys remember back to 2015, 16, 17, and this started up in Canada and it's made its way down here. It was a land grab. Anything that was not nailed down was being acquired by Canopy, Tilray, or a U.S. company. And it was almost like a hedging your bet. Well, I'm not sure if cultivation and retail is going to be the winner. Let me buy a software company. I'm not sure if software is going to be the winner. Let me buy a consulting company that teaches you how to grow and establish your infrastructure. Maybe that's not going to be a winner. Let me buy a licensed lab in Colombia. I'm being facetious about this, but it's true.
Mm-hmm.
nobody kind of knew which sector was going to be sustainable, had visible, predictable growth, and therefore was going to get capital and value. So they bought everything. And that leads to you kind of doing nothing well when you're in 5 different businesses. So when the market cracked in 19, as happens in every industry, when there's stress on the capital markets, when there's stress on your valuation and your ability to raise capital, you start to sell off everything that's non-core, because that's basically what the market's telling you to do. So what changed from an M&A perspective, it went from, let me buy everything because I'm going to hedge my bet. Well, the market said that doesn't work, to now it's more of what you said. It's accretive.
Yeah.
And whether that's buying revenues or cash flow or IP or brands or moving it to another state, the market is telling these public companies that have been the predominant acquirers, if it's accretive to the bottom line, to your brand portfolio, to your IP, I'll support that. Mm-hmm. But if some far-flung thing that is not core to the business, we're not buying it.
Yeah, no, the market castigates non-accretive acquisitions nowadays.
Market speaks, and the market spoke to this industry about 1.5 years ago. And that's when you saw a bunch of restructuring, MedMen and many others, by the way, it wasn't just that company, to cut back to what they do best and what's fundable. And that's where we're at now.
What about SPACs, right? Like you mentioned SPACs earlier. We know from the deals tracker that we've raised probably like close to $3 billion, in SPAC money. How are SPACs changing the M&A landscape?
An excellent question, Javier. Really in 2 ways. Number one, just fresh powder, of buyers to acquire, right? So it's about $3 billion that was raised. About half in the US and about half up in Canada. The NEO exchange principally has been kind of the basket for Canadian cannabis SPACs. Mm-hmm. Here in the US, it's been NASDAQ and the New York. That's what's interesting about the SPAC. So the average SPAC in the US raised about $200 million in their IPO. That's an institutional trade. Mm-hmm. Now, maybe they're going to buy the SPAC, sell off the equity, keep the warrants like SPAC buyers do. But nonetheless, these were institutionally funded deals, number one. So the institutional money came behind this opportunity to acquire in an industry that had declining asset values. That's why SPACs boomed around the world. Mm-hmm.
Who was investing in SPACs? Do you remember any particular big institutions?
No, but SPAC buyers are very particular because they're not fundamental buyers. There's no business there.
Nothing.
It's a platform for acquisition. So they're technical traders. That's what I said. They typically invest in the SPAC, they sell off the equity, they keep their warrants, and they're sitting at a zero basis. But the fact that all of the US cannabis SPACs, and there's been about 10, have IPO'd on either NASDAQ in New York, which will not allow a plant-touching company to list on NASDAQ in New York. They're all OTC. The biggest guys are small. It also means that they can't acquire plant-touching companies because the exchange won't let it happen. In fact, there's been one SPAC, Green Rose, that is downlisting. I've never seen this in my career. Downlisting from NASDAQ to OTC because they're acquiring state licensed operators. It's usually the other way. You go to OTC and you pray one day you can get up to NASDAQ. But what it does mean for the majority of private companies that were not state licensed operators, they were not getting acquired because it was the MSOs doing all the acquisitions. Well, now that you're a cannabis SPAC on the New York or NASDAQ, what are they buying? Software companies, biotech. So they're buying non-plant touching companies. And for a firm like Viridian, we represent companies in every sector. We were able to sell our 365 cannabis because the SPAC mandated we're buying software companies. Mm-hmm. So it's opened up the possibility for private companies in the space that were not state licensed to have an exit and to have a public exit, plus $3 billion of acquisition financing. So it's juiced the level of transactions in the market.
Indeed. Yeah, it's been like the hottest trend in the last 1.5 years, right?
Yeah.
And in many senses, I've heard you argue before, like SPACs saved the industry. I don't want to get too deep into this, but I don't think. I mean, just a quick one.
No, I don't. Look, if the industry didn't have attractiveness to the acquirer, there'd be no SPAC. You know what I mean? Mm-hmm. So I don't think SPAC saved the industry. I think what it did is just what I said. It gave the private non-plant touching company, which was kind of left out of the capital markets game for the last 5 years, to be looked at by the acquirer because I had no other choice. So I don't want to say it saved the industry. I don't think that's true, but I think it added $3 billion of purchasing power on the acquirer side. And because they trade on senior markets, that's attractive to a private company.
Oh, yeah.
It's not just cashing them out. It's the old double dip. I'll take some money off now. I'll roll over my equity into the public company. And hopefully when the stock's up and my lockup is done, I can sell at a profit too. So it just added a lot of juice for the non-plan touching private companies.
So we got this change in relation to the targets, in relation to the acquirers. There's also a change in the market related to focus, right? The days where companies did everything and those were the most desirable investment targets or the most investable companies are kind of behind us in a way, or on the way to being behind us, right? Why is that happening, and what do you see happening going forward in terms of industry focus?
We kind of talked about this, and I've known this in other sectors that I've banked. Investors like companies that they can understand and evaluate. Sell-side equity research analysts, of which I was one 1,000 years ago, like to cover companies that they can understand and evaluate.
Yeah.
And when you're in 5 different lines of business, and this is empirically true, there's a study done 15 years ago, I think, by U of Penn. Companies that have too great a diversity of businesses or assets are the least covered research covered companies in their industries because the analysts can't tell a coherent story.
Mm-hmm.
So diversity leads to a silo. You're not getting research coverage. You're not getting institutional participation. When you focus on your assets that drive your top line and drive your profitability, it's easier for the investor to understand, the institutional investor, and you get more research coverage. The market has spoken. We are in the age of the golden rule. The person with the gold makes the rules. And in this case, as Tim was saying with his panel, fundamental performance, companies that are generating 150 to 200 million a quarter in revenues, profitably so, they're sustaining or increasing margins, their stock is down 50%. So what do they have to revert to? Because you got to put headlines out there. They're becoming more aggressive acquirers. Mm-hmm. And lastly, as part of that, I don't know if we talked about this, with the equity markets down, it becomes very dilutive and expensive to issue equity to make an acquisition, to issue equity to do anything.
Yeah.
What's taken the place of acquisition financing in lieu of raising more money by selling stock?
Sale leasebacks?
Debt. So for those of you who follow Viridian or on the deal tracker list, we've been saying for 2 years, debt's coming into the market. We've not seen it before. Lenders are coming in because there's a lot of
exactly what
real
we were saying yesterday in the REIT panel, right? Like, it's equity no longer makes sense for most companies.
Well, not at this level.
Yeah.
4 months ago, it made a lot of sense, and the companies were issuing as much equity as they could because it was not dilutive. Debt has come in not just as working capital, as growth capital, and increasingly lower cost of capital, but as acquisition financing. The largest companies in the industry, like a Verano, a year and a half ago, the average coupon for a piece of debt was about 16 to 19%. This is not including the OIDs and the origination fees and the prepayment, but it's all that crap. The average nominal coupon was between 16 and 19%. Verano did a multi-$100 million debt deal at 7%.
And yesterday, I think Polaris did one at 4.7%. So 4.7.
And this is without safe banking coming in. Everybody thought safe banking, and all of a sudden, J.P. Morgan Chase is providing a credit line to a cannabis company. That doesn't exist. So the underlying fundamental strength, revenue growth, cash flow to service the loan, underlying assets to collateralize the loan, that's what's attracting the lenders. There's more lenders chasing these deals. And so the cost of debt capital is coming down significantly. It's needed.
Yeah. We have like 30 seconds. I want to double down on one of the things you just said, just to close it up. Do you see JP Morgan Chase financing cannabis companies when this goes fairly legal, or does it not? Maybe it wouldn't make a lot of sense for them to jump into the industry anyways. We were discussing this yesterday, right? Yeah, does it make sense to piss off some institutional supporters in the process? Will they do it?
If you have the cover of regulatory FDIC insured banks having federal guidelines to allow them to bank the cannabis industry, damn right.
But it's a sin industry. You go federal illegal, it becomes a sin industry.
So you don't think Anheuser-Busch has a loan from JP Morgan Chase? I'm sure they
Probably.
do. Or some other FDIC insured bank. This industry, and we're preaching to the choir here, is mainstreaming in every perspective. Capital markets, quality of the investor. We sold 2 California operators to private equity this year, early this year. I'm not sure if I've seen that before. Private equity. This was not cannabis private equity. This is private equity. So the big buy side, which has been, peering over the abyss, is starting to come into the industry, even without safe banking, even without more, even with a change in federal legalization. Just the sheer size of the industry, the growth of the industry, the mainstreaming of the industry, the type of capital coming in, and more important than anything, the underlying fundamental performance of these companies, you cannot ignore it if you're a lender or investor.
Very true.
You just have to be careful.
Very true. Scott Greiper, Viridian Capital Advisors. Lastly, where can people reach you?
You want my phone number, or what do you want me to give out?
An email, website, your address?
It's Viridian. Nobody's going to remember this. Do I have Viridian up there? No. Viridian CA, which stands for ViridianCapitalAdvisors.com, is our website. S. Greiper at Viridian CA. And if you can't get any of that, call Javi. He knows where to get me.
You can call me or events@benzinga.com. We'll put you in touch with Viridian. Scott, thank you so much.
Javi, great. Thank you.
Thank you.